If you were born before 1971, stop what you're doing and pay attention. Because the IRS has just released 5 new tax forms. And if you're a senior, you may be required to file at least one of them before June 30th. This isn't about a minor update buried in fine print. This is a real shift in how the federal government is tracking retirement income, Social Security benefits, and financial accounts for Americans over 54 years old. And most people, they have no idea this is happening. In the next few minutes, we're going to walk through all 5 of these new forms, what they are, why they were created, and exactly what you need to do. No fluff, no filler, just the information you need. Let's get into it. Every few years, the IRS updates its filing requirements. Sometimes it's a small tweak, sometimes it's a major overhaul. What's happening right now falls somewhere in the middle, but it hits seniors harder than almost anyone else. Here's why. After the pandemic stimulus years, Congress passed a series of budget reconciliation measures that changed how retirement income gets reported. The IRS responded by redesigning several forms that specifically relate to pensions, Social Security, Medicare-linked accounts, and inherited assets. For people under 50, most of this doesn't apply. But if you were born before 1971, meaning you're at least 54 years old, several of these forms now directly affect your filing status. The June 30th deadline is a quarterly reporting cutoff tied to these new requirements. Miss it, and you could face penalties, delayed refunds, or a flag on your account. So let's go through them one by one. You've probably seen the SSA 1099 before. It's the form Social Security sends you every January, showing how much you received in benefits the prior year. But here's what changed. The IRS has now added a supplemental worksheet requirement attached to the SSA 1099 for anyone who received Social Security benefits and had any other source of income, including part-time work, rental income, or withdrawals from a 401k or IRA. What this really means is the old threshold for how much of your Social Security is taxable has been recalculated. The IRS is now requiring seniors to complete this additional worksheet to verify whether their combined income crosses a new reporting tier. Why does this matter? Because a lot of seniors don't realize that up to 85% of their Social Security can be taxable depending on their total income. This new worksheet makes that calculation more transparent and more mandatory. If you're receiving Social Security and have any additional income at all, even a small pension or a part-time job, you likely need to complete this worksheet before June 30th. This one is specifically for retirement account holders, and it's gotten a significant update. Form 5329 has been around for decades. It's used to report additional taxes on retirement plans, things like early withdrawals or missed required minimum distributions, also called RMDs. Here's why this is now critical for seniors. The Secure 2.0 Act, passed in late 2022, changed the age at which you must start taking RMDs. It went from age 72 to 73, and it's heading to 75 by 2033. But the IRS updated Form 5329 to reflect these changes, and seniors who turned 73 in 2023 or 2024 need to verify their RMD amounts are correctly reported. Now, this is where things get interesting. If you took the wrong amount from your retirement account, either too little or under a misunderstanding of the new rules, you could owe a penalty. That penalty used to be 50% of the amount you should have withdrawn. Under the new rules, it's dropped to 25% and, in some cases, 10%. But you still have to file the form to document it. The revised 5339R is the mechanism for that. If you're 73 or older and have a traditional IRA or 401k, this applies to you directly. Schedule R is the credit for the elderly or disabled. It's been around for a long time, but not many people actually use it because it's often overlooked. Here's why it suddenly matters more. The IRS has revised Schedule R to expand eligibility thresholds. In plain terms, more seniors now qualify for this credit than before. The income limits have been adjusted upward for inflation, and the definition of qualifying disability income has been broadened. What this means for everyday people is straightforward. If you're over 65 and have a modest income, roughly under $25,000 for single filers or $32,000 for joint filers, you may now qualify for a credit you weren't eligible for before. A credit, not a deduction. That means it comes directly off your tax bill, not just your taxable income. The difference can be hundreds of dollars. Here's why this matters right now. Many seniors skip Schedule R because they've never heard of it or assume they didn't qualify. With the revised thresholds, there's a real chance that changed this year. Filing before June 30th ensures you capture this credit on your quarterly record and it carries through to your annual return correctly. Now you might be thinking, I don't have foreign accounts, this doesn't apply to me. Hold on. This one catches more people off guard than almost any other item on this list. The FBAR, Foreign Bank Account Report, requires U.S. citizens to report any foreign financial accounts that exceeded $10,000 at any point during the year. That threshold has stayed the same. But here's what changed. The definition of what counts as a foreign financial account has been expanded. It now more explicitly includes certain foreign pension plans, foreign mutual funds, and even foreign social insurance accounts, like payments received from a foreign government if you or your spouse worked abroad at any point. Here's why this matters for seniors specifically. A large number of Americans over 54 spent portions of their careers working internationally in the 1980s and 1990s. Some have foreign pension entitlements they've forgotten about. Some have inherited foreign accounts from relatives overseas. Under the updated guidance, more of these situations trigger the FBAR requirement. The deadline for FBAR is typically April 15th with an automatic extension to October 15th. But the June 30th date here refers to a separate compliance window the IRS opened for seniors who may have unknowingly missed prior filings. If you have any foreign financial connection, even a small one, it's worth reviewing this now. This last one is about investment income, and for a lot of retirees, this is where things get quietly expensive. Form 8960 calculates the net investment income tax, a 3.8% surtax on certain investment earnings above a threshold. It was introduced as part of the Affordable Care Act and has been law for over a decade. But here's what's new. The IRS revised the worksheet inside Form 8960 to specifically address how retirees calculate net investment income when they're drawing from both taxable brokerage accounts and tax-deferred retirement accounts simultaneously. The previous version of the form caused a lot of confusion and a lot of errors because the instructions weren't clear about how different income streams interact. Now, this is where things get interesting for seniors. If you're retired and pulling money from multiple sources, a pension, a brokerage account, Social Security, and maybe a part-time income, the revised worksheet now requires you to report these in a more structured, itemized way. What this really means is that some seniors who previously calculated their investment income incorrectly may have been underpaying, or in some cases overpaying, this surtax. The revised form is designed to correct that. Filing it properly before June 30th ensures your account is reconciled correctly. The threshold for reference is $200,000 for single filers and $250,000 for married filing jointly. If your total income crosses that line, Form 8960 is not optional. Okay, let's pull this all together. If you were born before 1971, here's your clear, simple action plan. First, check your Social Security income situation. If you have any additional income alongside your benefits, complete the updated SSA 1099 supplemental worksheet. Second, if you're 73 or older and have a traditional retirement account, confirm your required minimum distributions are correctly reported using the revised Form 5329R. Third, look at Schedule R. If your income is modest and you're over 65, you may now qualify for a credit you didn't before. Don't leave that money on the table. Fourth, if you've ever worked abroad or have any connection to foreign accounts or foreign pensions, review the FBAR requirements. The updated guidance may now include you. And fifth, if your total income is above $200,000, make sure Form 8960 is filed with the updated worksheet that reflects how retirees draw from multiple income sources. The June 30th date is a real compliance window. It doesn't mean you're in trouble. It means the IRS has opened a structured period for seniors to get these filings in order, and the smart move is to use it. The best thing you can do is talk to a qualified tax professional, CPA, or enrolled agent who specializes in senior tax issues. These forms aren't necessarily complicated, but they do require attention, and they do have deadlines. Stay informed. Stay on top of your filings. And don't let a paperwork issue turn into a financial headache. That's what this is all about.